Good day and welcome to the review of the Tax Considerations chapter, which is Chapter 7 in the SHRM Essential Guide to Employment Law by Charles Fleischer. Wages and benefits paid to employees are deductible from the gross income amount to compute the employer's state and federal taxes. As our text says, the amounts should be reasonable, ordinary, and necessary. There are some alternatives to deductions, and our text mentions some of them, such as the Worker Opportunity Tax Credit and the Supplemental Nutrition Assistance Program. There are other exceptions for what employers can deduct. Simply put, federal law allows companies to deduct all ordinary and necessary expenses of carrying on a trade or business. Most business corporations are classified as C corporations. C corporations determine taxable income by taking their gross revenue and then deducting the cost of goods sold, salaries, and other expenses. The amount left is the net income. Many times, C Corps share its net income with shareholders through dividends. Dividends are considered taxable income to the shareholders. As found in our chapter, there are other ways to distribute the net income. Like private organizations, publicly held corporations also have limits on how much that they can deduct. The Tax Cuts and Jobs Act of 2017 imposed a ceiling of $1 million on all covered employees. The covered employees include the CEO, the CFO, and the 3 highest salaried executives. The Securities and Exchange Commission also requires public corporations to disclose the compensation amounts to their highest paid executives, the CEO, the CFO, and the 3 top paid executives. We have already talked about independent contractors, but please read over that section found in this chapter. The federal withholding requirements include income taxes, Social Security tax, Medicare tax, and unemployment insurance contributions. There is a list in our text of exceptions to federal income tax withholding. Some examples include disabled workers and clergy. Employees who receive tips must report the amount to their employer on the 10th of every month. The employer must then figure out tax withholdings for those tipped employees. Although Florida residents do not pay state income taxes, please read over the state withholding requirements section. Earned income tax credit that is mentioned in this chapter is a tax credit available to low and moderate income employees. Taxes withheld from employees are considered to be held by the employer in trust. The employer has a fiduciary duty to ensure that deposits to the IRS get made as required by law. Many companies hire a commercial payroll service to manage the tax requirements. There is a list on page 152 of the services they provide. This concludes the review of the Tax Considerations chapter by Charles Fleischer. Have a wonderful day.